For decades, the semiconductor race felt pretty simple, right? It was all about who could get smaller, faster, and more powerful. But what if I told you that's not the only way to win anymore? Our analysis of the 2025 fiscal year data shows a fundamental shift, a huge divergence in the global foundry landscape that's completely rewriting the rules of the game. And this one sentence from our HDIN research analysis, well, it pretty much says it all. The old mantra, process is king, just doesn't hold all the power anymore. I mean, the very definition of what it means to be a leader in chip manufacturing is changing, and 2025 is the year you just can't ignore it. Okay, so that's a big, bold statement. But what does it actually look like on the ground? How are these companies changing their game plans to deal with this new reality? And really, what does it mean for the future of all our tech? Let's dive in and break it down. For the longest time, the playbook in this industry was honestly brutally simple. The whole fight was just a relentless march down the nanometer scale, from 90 to 45 to 28 and even smaller. But 2025, it marks this critical turning point. That old battlefield isn't the only one that matters anymore. New arenas for competition are opening up, and with them, totally new ways to win. This idea, process is king, meant it was the absolute law of the land. Victory was defined by one thing, and one thing only: who could build the most advanced logic chips. It was this straight-line race to see who could make the smallest transistors, and whoever got there first won the crown. And, of course, all the huge contracts from mobile and high-performance computing. And that right there brings us to the absolute heart of the 2025 story, a great strategic divergence. The source material calls it a splitting of paths, and that's exactly what it is. The industry isn't just marching in one single file line anymore. Instead, we're seeing two very, very different playbooks for success emerge. Okay, so this slide just lays it all out perfectly. On one side, you've still got the traditional logic playbook. You've got companies like SMIC and Nextchip who are still running that classic race, pushing on mature nodes like 28 nanometers for things like mobile phones and computing. But then you've got the specialty playbook. This is where companies like GlobalFoundries, Huawei, and DB HiTek are carving out these incredibly valuable niches in things like power management, radio frequency, and analog chips. The components that are absolutely essential for the huge revolutions in automotive and the Internet of Things. So right, if you're not just fighting over nanometers anymore, how do you actually win in this new world? Simple. You build a moat, a deep technological advantage in a very specific high-growth area that is just incredibly difficult for anyone else to copy. Okay, let's take a look at GlobalFoundries. They're going after what they call physical AI, basically the intelligence that lives right inside our smart devices, not just way off in the cloud. They're doing this with unique technologies like FDSOI, which is just a way of saying they can make these incredibly efficient chips that barely use any power, perfect for stuff that runs on batteries. And wow, is it paying off? Their silicon photonics business, which is critical for data centers, saw revenue jump by an incredible 29.1%. All right, now let's switch gears to Huawei. These guys are all in on the electric vehicle revolution. Their moat is built around power devices, specifically their 12-inch super IGBTs. Now just think of these as the super specialized switches that control the massive flow of power from an EV's battery to its motor. By absolutely mastering this critical piece of tech, Huawei has made itself an essential part of that automotive supply chain. And then you have DB HiTek, which is almost like a boutique foundry. They're not trying to do everything for everyone. No, instead, they are masters of one specific craft, high-voltage BCD process tech. This lets them create chips that can handle the insane power demands of big industrial machinery. By developing platforms that can handle up to 900 volts, they've basically cornered this very demanding, very high-margin market. So look, this whole story about divergence is compelling, for sure. But does the data actually back it up? Oh yeah, absolutely. When you dig into the financial and operational numbers from 2025, this split isn't just a theory, it's written plain as day on the balance sheets. Just take a look at R&D spending as a chunk of revenue. It's a huge signal of where a company is placing its future bets. You see Nextchip and Huawei right at the top, plowing over 11 to 13% of their revenue right back into research. And this isn't just general R&D. It's a super targeted, aggressive push to develop those specific, high-value specialty processes that will let them command higher prices and build a real lasting advantage. And then there's CapEx, capital expenditure, which tells this other really fascinating side of the story. On one hand, you've got this absolutely massive surge from Chinese firms like SMIC. We're talking over $8 billion in planned spending. This is all being driven by a powerful push for localization, a national effort to build a self-reliant supply chain. Then, on the other hand, you have GlobalFoundries with a much more targeted spend, but it's strategically boosted by government help like the US CHIPS Act. It's just two totally different ways of thinking about how to grow. Okay, so as we're talking about all this, you're going to hear the term WSPM thrown around. This is a perfect time for a quick analyst's corner. WSPM simply stands for wafer starts per month. It's really just the standard way the industry measures a factory's maximum production capacity. So for example, a specialty player like DB High-Tech has a capacity of about 154,000 WSPM. Just think of that number as the heartbeat of the factory, a direct measure of how much it can produce. So here's the billion-dollar question, right? How do these specialty moats actually create real-world business stability? Well, this single number says it all, 63%. That's the percentage of GlobalFoundries business that is single-sourced. This means that for nearly 2/3 of their products, their customers have no other supplier. Their tech is so unique, so baked into their customers' designs, that switching is just not an option without a massive, expensive redesign. Now that is a powerful defense against price wars. All right, so let's pull all these threads together. We've got the divergence, these specialty moats, the big shifts in investment. So what does the new playbook for winning in the foundry business actually look like now? First up, the focus is shifting away from that old race for smaller nanometers and toward dominating specific, high-value applications. Second, localization of supply chains is no longer just a buzzword. It's a core strategic imperative that's shaping billions in investment. And this is a big one. Success now demands deep, collaborative partnerships with customers, creating these incredibly sticky, long-term relationships. And finally, the competition just isn't one-dimensional anymore. It's a multi-front war fought across process tech, advanced packaging, and intellectual property. So yeah, the era of a one-size-fits-all strategy in chip manufacturing, it is officially over. This great divergence of 2025 proves that the future is all about being specialized, localized, and deeply collaborative. So the real question, the one we'll be watching for the next decade, is which of these paths, which playbook, is going to create the most value in the long run. For all the data behind this analysis, you can get the full HDIN Research report on our website. Thanks for joining us.